All right, good afternoon, good evening, everyone. Welcome to the August 2022 meeting of the International Model Investment Club. For your background's sake, we're founded in May of 2016. This is an international model club that is open to the public to join and to attend our meetings. We have monthly meetings that occur on the third Mondays of each month, and on December's we meet on the second Monday of the month. In this club, we do use only hypothetical money with fixed deposit amounts based on our membership. This helps us avoid any issues with currency exchanges, with taxes, and the particulars of real money. And so this allows us to be more of a learning lab for the better investing principles, and to use a fundamental stock investment based on values, and using the online stock selection guide to inform our decisions and to operate. All meetings are held online, and this allows us to have an international roster, as well as the hypothetical money. It does help with us having an international community. We have 12 members in the United States, Canada, and China. So multiple time zones, all are welcome. If you would like to direct yourself, the agenda for tonight's meeting is in the handout section of the control panel on the right-hand side of your screen. All visitors and guests will be muted for the duration of the meeting, and you may post your questions in the questions subsection of the control panel on the right-hand screen as well. We will do our best to address them in real time, and if we don't get to them in the middle of the presentation, we will we'll go through the questions at a dedicated period at the end. At the end of our presentations, you'll be then unmuted, and we'll seek your feedback if you have any comments or questions at that point. And so this is an important disclaimer. The information presented here tonight is for educational purposes only and is not intended as a recommendation to buy or sell any securities that are mentioned. The views expressed tonight are those of the participants only and do not necessarily reflect those of Better Investing. Investors should conduct their own research and analysis before making any investment decisions. And securities discussed tonight may be held by presenters in their own portfolios. The presentation tonight may contain images of websites, products, services not endorsed or recommended by Better Investing or the presenters. The meeting will be recorded and will be posted on our YouTube channel for future reference, as are our past meetings. So if there's any company in particular you'd like to see or previous meeting, please feel free to check up our YouTube channel. At this point, we'll go through the agenda for tonight's meeting. Let me pull that up, pardon me. Thank you. So we'll begin tonight's meeting with the Treasury report. Then our member Piero will give us an educational topic on the triple play. Tonight we have a long list of quarterly reports that are due. So we will be going through the companies that are recommended buys and sells in priority. And then we will have open discussion on the remaining holdings as appropriate. So at this point, I'll turn the meeting over to Reddy, for our treasurer, for the monthly treasurer's report.
Okay. This is the treasurer report for this month. I just prepared yesterday and today. By the way, there are some small corrections based on which date we are closing our transactions and which date we are paying. So this is the latest one. Please ignore the one I sent by email. This month I deposited $1,100. I did skip Mahesh and Bernard Scoville. I did not deposit for them. So there are 11 active members. I deposited 11. Last month we sold Freeport McMoran FCX 110 shares. We bought it at this price. This is the opening price on July 20th, the next morning open price, and the cost is $3,137. And we sold also Biomarin, all the shares that we had. The proceeds are $3,268. Hey, I wanted to check this one. I did not adjust this yet, but Bernard Scoville's payout is There are 2-3 different ways of checking it, but this is the number I got it, best number I got it. We owe to pay out 6,201 as of 7/19 after our meeting. I do this. Without doing this, we have a cash balance with today's deposit of 7,144. Yeah, manually adjusted Google stock split. Then I remember that the program cannot do automatically also, which I did for Amazon last month, some other stock. I did this manually today, and numbers look correct now. This is the heat map. The way I found is Google was split and not adjusted. Google was showing very small block. Then I went ahead and did manually. Still Vertex is our biggest one. We have good amount of cash, but we had to pay Bernard. We cannot buy any, we don't have any money to buy new stocks for today unless we sell some. Our winners and losers are Schwab and Vertex, same as last month. The losers are Google and LGI, but Google we just recently bought, and so we have a small loss. Next slide is, this shows the overall gains and losses. You can see slowly more reds are turning into blacks because stocks prices are going up. Next slide is, you can see on the left side, this one still a big negative compared to the market indices. Next one is club assets. We have 1, 2, 3, 4, 5, 6, 7, about 11 stocks, and the cash, if you pay Bernard, cash will be close to a small amount left. Diversification, we did not change much, except Mega went, I think, 1% more, and cash became 11%. The sector map shows that we are still three sectors are missing. Consumer defensive, energy, and industrials are still missing. Otherwise, we represent about 8 sectors. Is that the last slide? Yeah, that's the last slide. Any questions? Hello?
Quick question. So if we pay out Bernard, we basically have no cash left to buy stocks, correct?
Not much. I think we have about $1,000 or so.
Okay. All right. Thank you.
Well, thank you very much, Ray. I think that was a great presentation. If there are no questions at this point, then I think we'll turn it over to Piero for tonight's education topic. Ready, are you to?
Yeah.
Thank you very much.
Okay, so I'll show my screen, yeah. Okay. Okay, so let me get rid of this.
You're okay, Piero. You don't need to get rid of it. Just do the slideshow. Yes. Yep.
Yeah. Okay, from the beginning. Okay, so this is the triple play. Oh, there it is. So, you know, in the value line sheet, this is the top half of it. This is where the triple play really kind of, you quickly get to see it, right? So the first thing we look for is kind of the depressed price, which is, you know, right here, $59.76. This interestingly, it's First American Financial, FAF.
Right.
Okay. So anyway, here's the price graph. The current price is right here. It's below the trend line. So when you see the price below the trend line, it's usually because, it's an unjustified reason. And you can figure that out by reading the value line report, further on. He'll tell you what's going on, and you can figure out if it's depressed for a real reason, for fundamental reasons or not. And also your background reading will tell you that as well. Okay, the second thing is got to look for PE expansion. And the PE, they calculated right here, it's 6.3. And then they also managed to project it here out for 4 years, 5 years. Average annual PE would be about 13, so PE expansion. And the last thing you want to look for is margin expansion. And here they tell you the margins. It's usually expanding somewhat. So go to the next screen, which will, shucks. A depressed price. That's right. So the trend line, price line, right? And usually the price will return to trend. It's usually depressed for unjustified reasons or return to trend. Now PE expansion 6.3, and the projected average annual PE ratio will be 13. So 6.3 is 13, PE expansion. And then that last thing we look for is margin expansion. Now for FAF, what we're looking for is underwriting margin, right? It's going to go up to 38%, and it has in the past it's been 37, 36, 35, 35.9. Now for FAF, it's an insurance underwriter, so we're looking for the underwriting margin. That's where they make their money. Most of the time, you're going to be looking for the net profit margin. All right, a projected net profit margin will be 30.6. But in the past, it's been 29.3, 27, 24, 24, 23. So this company is getting much more efficient. It's producing more and more of a profit. They're putting more of their earnings into their pocket as profit. And that's the end. Any questions?
Can you
Could you
summarize
explain
again?
what-
So, yeah.
I'm not being from finance background, this triple expansion and some of those definitions will help.
Yeah.
What exactly they define?
Okay. Ask the question.
What definition of margin expansion?
Well, margin expansion. Well, net profit margin. All right. So what's it called? Pre-tax profit, right? Well, when the pre-tax profit goes from in 1 year goes from 10%, the next year it goes up to 12%. The margin is 2%. It's the little kick up. And what we're doing for margin expansion. So we have net profit margin. Net profit margin going forward is going to be 30.6. What it has been in the past is 23. So the margin means the difference between 23 and 37.
And Pierre, what does that indicate? Does that indicate efficiencies?
Yeah.
That the company has, better management?
Yeah. Usually when a company, wants to become more efficient, they start cutting out the fat. They see what things they need and the things that they don't need. You have too many employees, start reducing the number of employees. You have a division that's not really contributing to the overall profitability of the company, they get rid of it. They start trimming the fat. This kind of thing can only go on for a certain period of time, because then you start cutting muscle, all right? So they start cutting off the fat and their margins improve. If you want to keep, it'll improve for a while, but in order to improve continually, they'll have to reinvent their products or their service. It come up with a more profitable product, something that they can sell for a higher price, or a service that they can sell it for a higher price. That's the kind of thing that drives profitability. And the margin is just what it used to be and what it is now. That's that margin.
So is every number listed there, is that every year? Can't see
Okay.
the heading.
Yeah, you see, yeah, this darker number, this is the projection. This is a projection for 2022.
Okay.
This is 2029. 2021. Yeah.
Okay.
The lighter numbers, not the darker numbers. Darker numbers are projections. This is 2022. This is 21, 20, 19. Those are the actual facts. These are the projections. That's a
So then
projection.
so it's 30.2 2023 and then
30.
20.
30.2, where's that? 30.2, yeah, that's next year.
And then what's 30.6?
30.6, that's for the next 5 years.
Oh, next 5 years. Okay.
Yeah.
So
there's
we want something that's trending up on that one.
Yeah. Okay, so you see here, what is it, the profit margin? Okay, well, this is going to be underwriting margin, the same thing. On FAF, they didn't give the net profit margin, they gave the underwriting margin, right? So projected forward, it's going to be 25 to 27, the year's projection. And the one that they the next just ahead is going to be the next year, 2023. 2022 is this one that we just going through now. And then this is the year before, which is 2021, 2020, right? The lighter colored numbers. These are the lighter colored numbers. Those are the years, those are the facts. Those, you can't deny those. 2022, that's a projection because this is in, the date here is, shucks. I think it was early in the year. I think the date's at the bottom, as it's always done that. And so this is a projection for this year, and this is a projection for next year. All right.
So okay. So
and this one is a projection for 25, 27. So they're making a projection for 23 to 27. It's a 4-year projection, almost 5.
So are we looking at underwriting margin, or what was the other term that you're
Well, net profit margin.
net profit? Where is that?
Okay,
Net
usually
profit.
it's down here, right? But here, this is a report for FAF. They didn't report the net profit margin. They reported the underwriting margin.
Okay.
So we'll go to a larger picture here. There it is. So yeah, the underwriting margin. The net profit, they just gave the number. What profit did they put in their pocket? They didn't tell you the percentage, right? But here, this is a different company. And this is what you usually find, net profit margin 30.6. They don't tell you the actual dollar amount that they put in their pocket. They're telling you of all their sales and earnings, they put 30.6% in their pocket as profit. And it's
Another thing-
improving.
Yeah.
It's improving from 20.
Piro?
Yeah.
For insurance companies,
Yeah.
underwriting margin is similar to net profit margin for other companies, right?
Yeah, for the insurance company, it's an underwriter, an insurance underwriter, underwriting margin. So every time they write an insurance contract, how much of that, how much of the person who buys that underwriting contract, how much of that money is they're putting in their pocket? So that's the underwriting margin, 38%.
So if you go down 2 lines below that, though, doesn't the number drop? It goes from 1030 to 1050 and then down to 1010.
Okay, 1010 is the actual dollar amount.
What and the other one to the left of that is aren't those dollar amounts too? If you go to the left, right there.
Yeah. Dollar amounts. Yeah.
So doesn't it go down? You should project the next, like this year would be 10.
This year would be 1030.
And the next year goes up to 1050.
1050.
And then how about 1010?
1010 is the next 4 years.
So
right?
it actually goes down.
That's right.
Right?
Yeah.
Okay.
Yeah.
But that's not for FAF, or is that for FAF?
That's for FAF. So they're going to be putting less money in their pockets as profit, but their percentage that they're going to earn is going to be higher, and that could be because they're going to charge more.
Okay.
All right. That's how to
So,
read that.
okay. And then the first one was price. I got that. The price
Yeah.
is going up. I mean the value is like low compared to,
Yeah.
right? Depressed
Yeah,
price, right?
yeah, depressed price.
And
That's
then
right.
what was the other one?
The second one would be PE expansion, which would be on the value line sheet. They give you the PE ratio right now. They have the current price, the current earnings, and they give you the PE, right? And so what they do then is they tell you there on the right, remember, the average annual PE ratio going forward will be 13. Well, the current PE ratio that we just calculated was 6.3. So they're telling you the annual PE ratio is going to go up to 13. So the PE is going to expand.
Which is a good thing, right? Meaning they have.
Yeah. Yeah, which is a good thing.
Can we look at Facebook?
I have more questions. I actually
Okay, all
have
right.
more comments. So for the margin, actually each industry, the margin will be different. We really need to compare with its industry.
That's right.
Whether this company is, let's just say if this industry like a 35%, that means they are doing, what was the margin for this industry, FAF again? I lost underwriting margin. I'm looking. What is it? 30, 38? So that means they're better than the above the average, above the industry average. So we really have to look at what's the typical average industry margin is, then give us.
That's right.
Where do you get the typical? Where'd you get that?
Look at the peers.
Look at the peers. You go to SSG. You know how there's a comparison. So that's how you will find it.
Yeah.
You also we need to compare to the competitor.
That's right.
Yeah,
when
but
we
do you
do
have
the first cut, we do the first SSG, you know, that's another way that we need to evaluate that.
I can't remember though. Do they give you an industry average, or do you have to randomly pick and compare all of them, or I can't remember?
Why do we take a look after?
Yeah.
Do you have SSG? Do you have SSG on? We just pick anything. We just want to take a look.
Yeah.
Puro shows the
Okay, let me go to the my SSG.
Just pick anything so we can see.
Okay. When you compare peers, right?
Yeah.
Here it says industry average, peer group average.
Okay, so they give it to you. Okay.
They give it to you.
No, you have to look for it. Margin, where is it?
What do you mean the margin? Well,
you have a earning per share PTP, return equity. Where is it? Which one is it? Pre-tax profit?
Pre-tax profit, sure. That's before taxes are paid, right?
Yeah.
Okay, and then you have to pay taxes. So the net profit margin is you've already paid taxes, you've already done everything else. That's what you put in your pocket. But the pre-tax profit is you still have to pay taxes.
Yeah, but where's the industry average for that number?
Okay,
where is that? Okay.
Right here, industry average, peer group average.
So what is the number? I'm
not sure this peer group average is the margin. Why don't you take a look at FAF? Then you will know. If it's a 30%, then you will know.
Oh, I don't have my SSG for FAF. I have it for Amazon, just as an example.
Okay.
Yeah.
I don't know. Anybody knows this peer group average meaning is the?
Well, right there, right? Peer group average. BetterInvesting tells us it's about 5%.
Oh, sorry. I'm not sorry. Pre-tax profit.
Yeah. This pre-tax profit. Yeah.
Can you go up a little bit? What else are there?
What else is
Do they have a return on equity? So which one are we supposed to look at? Should that be return on equity is the margin?
No, the margin, no, the return on equity is, you put money into the company. How much are you getting back? If you put $10 in, are you getting $15 back?
Should that be margin? Same as a margin. Margin is how much you put in your pocket. No?
No.
But it's not the return on equity. The return on equity is when the company invests money into the company, and how much are they getting in sales based on that?
Oh, this is the sales.
The pre-tax margin is a different thing. The pre-tax margin is after you've spent everything except taxes, how much is left over for you.
Yeah.
So then, meaning the SS does not have that data.
Yes, it does. It's the pre-tax margin on, it says percent PTP on sales is actually the pre-tax margin.
But Piero's was net, not pre-tax, right? It was net. margin. So that's
net
after taxes.
Right,
Oh,
so
I see.
unfortunately, the SSG only talks about the pre-tax margin,
Pre-tax.
but there
Yeah,
are a
that's what
bunch
I'm
of,
saying.
but there's, gross margin, operating margin, pre-tax, and net profit margin, but they only show you the pre-tax margin.
So my question was, if we were supposed to compare it with what other companies in the industry, what's the average, so that we know what average means for that particular industry, we have to manually, like, that's what I'm
You have to
saying.
go
We have
through and find you have to go through and find your peers, because
Yeah.
sometimes the peers that they pick are not really that wonderful.
Yeah.
Nagumi, I think you just use the ballpark. I mean, so you kind of combine the value line with your SSG. So you're not going to get exactly
Right.
apples to apples with the value line and the SSG, but you're going to get a feel for how that particular company compares to the industry average on the SSG.
Or just two competitors among these two companies, which one
But
performs
I'm
better?
talking
Yeah.
about the net versus pre-tax or pre.
That's right.
So you're not going to, I mean, but you're going to get an idea.
Yeah. That's right.
It can't be that far off.
Yeah. Yeah. And usually when you get the peers, you're comparing peers for pre-tax profit. Well, if in this year, your company is the best one, like the best one performing, you keep that in mind, because in future years, if your company is now the second best performer or the third best performer, it's losing its relative position within the peers. And
okay. I
Yeah,
thought peer had a specific meaning, that it didn't necessarily mean it was the same.
no, the peer means the company that you compete with.
Right.
Yeah, that's what I'm saying, though. I thought peer in the BI term didn't necessarily mean companies from the same industry. That's
But it
why they
should be,
have
but that you can't compare, but just like someone said before, you can't compare
then what's the
the
difference
pre-tax
between?
margin are different for different industries. So if you're
That's right.
comparing it to something in a different industry, you're going to that's not going to be the same.
Yeah, but they have an industry average below. Then what's the peer group average?
But the peer group is it's the companies that you choose at the top.
Yeah, those are
Okay.
the ones you're directly competing with. The industry, there are a number of
Pull that down a little bit so they can see the companies that you've chosen on this one.
yeah. Here, this one I chose Walmart.
Pull the screen down a little bit. Okay, so
yeah.
you see on this one, it's Walmart, Wayfair, and Shopify.
Okay, so you manually.
And those are the peer group members that he's chosen for Amazon.
Gotcha. Okay.
Yeah.
Right.
Yeah.
So he put those in. They may or may not have picked those when you automatically, the automatic things that they pick sometimes are not so good, and you might have to change it a little bit.
Gotcha. Okay.
So yeah, when you go, okay.
So
Target.
so if you pick the companies that do the same thing, then you're gonna get a better idea of what the pre-tax margin and the return on equity are.
So I want to compare Target, right? Target Corporation. So I put in Target. Now update the study.
Here we go.
Okay, so now Target appears.
Right.
As in the statistics, right? So the 5-year average for pre-tax profit, 5.9. They're outcompeting Amazon, 5.3. And then you have a graphical representation, right? So here, peer group, that's the one that I just chose for Target.
Gotcha.
And that's the orange line, I think it is, kind of orange or purplish line.
Purplish, whatever.
Yeah, something like that. So it's all there.
Okay, and industry is fixed. It has a industry average is fixed.
Oh, so there it is. There, Target.
Hero, I have an overall question.
Yeah.
Okay. I generally try not to look at historical sales or historical EPS because that depends on the company size.
Yeah.
I look at PTP, percentage PTP on sales, and the percentage return on equity. Among these two, which one is better parameter to compare?
Okay. Well, pre-tax profit on sales, that's better.
That's better.
Yeah, because this tells you the profitability of the company. There's return on equity. Now, when the company makes money, what they give back to you in terms of dividends or interest payments or whatever, it's up to them. Sometimes, you get the fast-growing companies, the new technology startups, they don't pay anything back. You get nothing from them. they're just increasing sales and increasing earnings, and they're keeping it all. The return on equity is very small. And they're keeping it all to grow. So they grow really fast. And then when they mature, then they start paying a dividend.
Oh, the return on equity means what the stockholders are getting in the form of dividends.
That's right. In terms of money back.
But doesn't that also include the money that the company invests in their own and what they're doing to make their product?
Yeah.
Not necessarily dividends.
Okay. So what happens, like, you know, when you buy a company, right? You buy it for $10, the stock, the share. When you go to sell it, you sell it for $15. So the sale is $5. That's your return. Well, $5 out of $10 that you initially paid, payout is 50%. No, what is it? The return is 50. The gross return is 50%.
But the return, all right, the definition of return on equity is your net income divided by your shareholders' equity. So it's the money that's put into the company and how much money the company then is able to make in sales based on how much money is put in.
Yeah. Total investment.
It doesn't really have to do with dividend.
Yeah. Well, yeah, the money that you can take out of the company in either dividends or selling the stock.
Share buybacks or anything like that.
Yeah.
Return on equity is how much the money the company puts in and then how much sales they're able to get for how much money they put in. So some companies don't do, like, say, research and development on their products. Most companies, you know, I mean, biotechs are always doing research and development. Industrial companies, for the most part, do research and development because they're trying to improve the products that they're selling. So whatever money they make, they may take some portion of their profit and they put that back into the company to improve their products. That's equity putting into the company. Now, how much of that equity that they put in results in sales or in increased sales? That's the return on equity.
Wait, but the return on equity is what you put into the company. Because
It's what the company. It's not what we put into the company. It's what the company puts into the company. It is not what the shareholders do.
Yeah, it includes debt also, right?
Yeah.
Yeah, Ron said the higher the debt, the higher the return on equity.
Return on equity. Yeah, the debt can make it seem like they're getting more out of it. That's because they have more money available, but it's not really true.
Well, okay, because what was it called? That's right, the debt boosts return on equity and suppresses return on assets. Right. Okay. So the return on equity, but you know,
one more comment from the audience is they want to know, when do you look for a triple play, Piero? When you're
always.
So, but if it's positive, that's a good buying opportunity, right?
That's right. You know, with these indicators, those three indicators, many companies have one or two. Right. Some of them have three. When you find ones with all three indicators, buy it, because that's most likely to go up.
Isn't that usually, though, when the price has gone down?
Well, when what's it called? The suppressed price, unfairly suppressed price. Yeah, for that one particular indicator, yeah, the price goes down. If the price is staying on trend, well, then you don't only have a triple play, you have a double play.
So what was going on with the market in the last couple of months when all the prices were going down? That was more of a time to look for a triple play.
Yeah.
Okay.
Yeah. Fine. You know, but you always look for it. You just check it as a reflex. You do it with a value line.
Okay.
So summary, triple play.
It's a little after 6. Do we need to move on?
Summarize one sentence. Triple play.
Yeah.
That was good. That was very good.
Yeah. Suppressed price, PE expansion, margin expansion. That's it.
Okay. Thanks, Piero.
That's the best way I've heard it explained. That's good.
Yeah, that was great. Thank you very much.
Okay.
Are we going to quarterly reports?
Yes, we are.
Yes.
So looks like we have a few potential buy-sell candidates. So I think we should go through those first. And I think the first one, it looks like, I think, Mikumi, you have a recommendation for a buy on Meta.
Yeah, even though we don't have any money, I'd like to look at the value line.
That's
Just to-
okay. Yeah, that's
to
okay.
go
People
over.
can buy on their own portfolio, personal portfolio.
Okay, so can we look at value
Yeah.
line and see, look for the triple play? I don't think we have it, but
Oh, you don't have a value line?
I have, I have it open, but if you want to, it's in my folder, whichever way is easier.
Okay.
Whose screen are we looking?
Oh, take the screen from me. Take it away
Okay.
from me.
Is that okay, Megumi? You be the presenter?
Yeah,
Okay.
I don't know how to take it from.
Okay.
You'll
Right
see
here.
it.
You see it.
There'll be a dialog box.
Okay.
We can,
Can you see?
your screen.
Yeah, we see your SSG.
Okay.
Oh, there you go. Okay.
Okay, so let's start with price. So here is, oh shoot, I can't, how come I can't, oh, I can't mark it. It's too bad. So here, this dashed line is
Trend?
what do you call it?
The
Trend?
value.
You can mark
Trend?
it. You have all those.
I
Trend
can't.
down.
What's that? Yeah,
And
and then
that's-
this is the current price. So
Yeah.
that's one,
That's
Yeah.
one.
right? And then we go to net profit.
No,
No,
PE.
PE,
Oh, PE was
PE at
second.
the
Okay,
top.
fine.
go back at the top.
It's
13.3.
3.
Mm-hmm.
Okay, then
And-
on the right hand side, it says
Mhm.
average annual,
PE 25.
25.
25.
So that's
So
good.
PE
That's
expansion.
That's
Yeah.
good.
And then we go to the right here,
Net-
net profit
Net profit margin.
is
Oh.
what is this, 26.4. It is went trending
Down.
Down.
Yeah. Yes.
net profit
Okay,
margin.
well, That's 2 out of 3. 2 out of 3.
2 out of 3.
Yeah.
2 out of 3
2 out of
isn't
3.
bad.
It's becoming
So-
less efficient.
Yeah, and they said that. Yeah, so they're gonna in the earnings call, they said that they're gonna stop hiring as many people. They anticipate expenses are gonna go up and sales are gonna go down, primarily because of macroeconomic conditions such as inflation. They're still dealing with Apple's iOS changes.
Yeah.
So, but the price is kind of down. So, and then the long-term sort of forecast is good. So that's why I was recommending a buy if we had money, but we don't. So,
Well, club does not have money. Maybe people have money. Members have money.
yeah, I would buy.
Okay, can you show us what are you projecting?
Yeah, so let's see.
Okay.
So
Yeah, your SSG.
let me open up my PERT so I remember.
Okay.
So the closing price was 180 on the 12th, whatever day that was. Today's so that must have been on Friday, at least when I checked it. So the price is going down. I changed my projections from last quarter 14 to 10. Kept my earnings projections the same because forecast is good. These are all numbers. They are sort of
More
negative.
Going down.
I don't know what else you guys want to see. Let's see. Let's go to current PE is 14.7, average is 24.3. For my average high and average PE, let's see, what did I do? 14.7, 24.
I feel 6.7 is pretty optimistic. You can totally even lower it, I think.
Where is it?
No, I'm looking at the upside down ratio, 6.7 to 1.
Yeah, what did I pick for low price? Forecasted low price 127. 121 basically. So you're saying that could be lower? It could be.
Your high price can be lower too.
So I don't know, I think let's go 20.
My earning per share, 23.20.
And let's go to like it was 120. So what's 20% below 24? So let's go 185.
Hmm.
What's the price?
Oops. Wait.
What's
Below
today's
price.
No,
price?
it was 120, so it can't be
Minus-
185.
I
Yeah.
meant 120.
120 of 80%, you said?
Yeah.
So
So what is that?
96? 96.
Okay.
96
Still a
is
buy.
still.
Yeah, I mean,
Still a
but that
Still
makes
a
us feel a bit better. 3.5 to 1, you
Mhm.
know, just a bit.
96 is too low.
Can,
No,
can
it's
we,
too
can we
high.
take, can we
Well,
86
take
it's
a look at the,
120
86 is
today.
better.
can we
86
take a
is
look at
better.
the first page again? First page? So just look at the trend, the management trend going down, the return equity margin, all that. So
Okay,
pre-tax
so
profit.
here is a high in
and,
2017, and then it's been trending down, went up a little
It's
bit.
still pretty high.
Yeah.
Still pretty high.
Their net margin is like 43% or something like that. Return
But
on
remember,
equity.
they're also spending a lot of money on this metaverse thing.
Yes, but
What's
that's
this a
intentional.
10%? Yeah, what's this a 10%?
Yeah,
Are
whatever
they,
whatever that is, they're spending a lot of money on it.
Yeah.
yeah, do you know what it is? Is it
No,
like
nobody knows what it is, and they can't explain what it is. But they're spending a lot of
Metaverse?
money on it.
Metaverse, so it's not
Well-
just Facebook, it's a bunch of tech companies that are coming together to create this universe where they can, engage in various activities like games and social interaction where you wear this
Uh-huh.
headset and you interact with people.
Mm.
So it's a long-term project, let's just
Right.
say.
Mhm.
And it's not just all Facebook, so there is a risk there. But they're sort of all in on it, and I think that's the sort of the risk that you're taking. They separated
Facebook
out
has
their
has a ton
their
of users, right? They have a
what
ton
was
of
that?
users throughout the world.
Yes,
They
it's like
basically need the internet to be more developed across the world in Africa and elsewhere, or this metaverse thing is going to work out for them. I mean, they've like maxed out, who could go on their platform, pretty much.
Hmm.
It was like how many billion is it 2 billion, or is it just still 1 point something billion on Facebook
the number
right
of people.
now? Yeah.
Or the number of people who use Facebook, or
Yeah.
is like 3.5 billion. It's like
Yeah.
half
Well, yeah,
the
I mean,
population of the world. Okay, so so maybe they don't use it like daily, but on a monthly basis, it
Yeah.
is still going up. It's decreasing percentage wise, but and they're doing and I'm not a Facebook user, but they're adapting to the trends. For example, they're losing like the younger crowd because everyone's switching to what do you call it, like Snapchat and TikTok. So they're
TikTok.
pushing money
TikTok.
towards short-term videos, which is what they call reels.
Yeah, they're doing a TikTok wannabe.
Yeah, and also too, like all the
And they're
tech
hoping
stocks
that
are down.
people will stay.
Well,
It's
good,
not like
I have a question.
True.
Do you still feel
Yeah.
like the growth estimates are 10 for sales and 14 for EPS when
well, if you go to here,
Can we just take a look at the last 5 years, how they are performing, not using the 10 years? Can you cross out on that? It's just the last 5 years, how they do?
on the sales.
On that, on
On
the scale?
everything.
No, everything.
On the scale.
Go to the,
Go to the graph and
yeah.
and click off 12, 13, 14, 15, and 16.
One, two, three, four, five.
It's just made it better.
Still
Yeah.
not bad. Still not bad.
So 2019 is the COVID year? Or you
20.
consider 2020
20.
COVID year?
2021.
Oh,
19,
what
yeah,
happened?
somewhere around in here.
Okay. Oh, 19 just started.
And they said this is reflects sort of in the pandemic it went up because everyone was starting to go online because they couldn't meet in person. So they're they've been projecting that it is going to fall. So there aren't. I mean, there's not very many surprises as far as I can tell.
True.
They talked about. Yeah.
Go ahead. Finish your, what are you going to say?
So if you look at here, the estimates, BI 2 years 5.7, but value line for 1921 to 25-27 is 18. Yahoo is 11. Zax is
Value
almost
line
12.
is very optimistic.
Yeah.
But Yahoo's 1 year projection. Zach is also 1 year projection.
Yeah.
So my brother-in-law, he works for Blizzard, a large gaming company. So I asked him about this meta thing, metaphors. So the problem he did not like it. First of all, is that also his coworkers too. If you want to use their service, you have to have Facebook account. They don't want to use Facebook. That same thing happened to my husband. They don't want to use Facebook. So he was telling me it was pretty lousy, and you have to have Facebook to sign up to use their service. That was their drawback. Just kind of FYI. Yeah.
Well, does it mean that each company that's going to be involved in the metaverse, you have to be, you have to have an account with each of these companies?
I think you just have to have one, probably
one.
one.
Facebook. Yeah, as right now, you have to have a Facebook.
Yeah.
But they don't want to.
I've seen people use that Quest, like those, the headset, and shoot, if it, okay, so I'm not a Facebook user. I was never interested, but if it meant that I could wear one of those and do this virtual thing, I would consider it. I wouldn't do anything else on Facebook, like post
But
stuff.
what would you do with Quest?
We'll be able to engage and play games and interact with people on the metaverse.
Oh,
Not
and what does that
exactly
mean exactly?
Like virtual reality.
Okay, never.
Virtual reality.
Reality, yeah.
So, for example, at work, we have, I'm an architect, and you can put on these headsets where you can walk through a space. I imagine this is how design is going to go in the future. Is because a lot of people can't read
right.
plans,
Okay.
right?
So you can get 3D renderings of your
say,
buildings.
I want this color cabinets here. Let's push up the ceiling 2 feet higher, and you can see it all sort of in real time.
Okay.
So I imagine
That's pretty cool.
Yeah.
I think they do that a lot with biotech stuff too.
Yeah, I'm not sure. I don't know.
Yeah,
but that's how I imagine it.
Yeah. I have a question, Megumi.
Yes.
Zuckerberg is spending $10 billion per year on metaverse, which is nobody defined well what it is, what is that, and what it's going to do, and how people are going to like it. But he's spending $10 billion out of hard-earned profit otherwise on this concept, and he's not able to define exactly what his mission is.
Well,
he's assuming that you will agree with it because he's been so successful up to this point.
Yeah, I mean, I guess that is
that's a lot of money, but he's assuming, and he's not wrong to some degree, that he's been very successful up to this point. So why would people not think he would be able to do it?
And he is being transparent about it. They've talked about it for a year or two before it happened. They actually split their accounting so that you can see the family of apps versus this other, Reality Labs. It's all there. It's transparent. So, I mean, you can tell they're committed to it, and whether they succeed, I don't know. But they are the biggest, social. What do you call? Social connection platform. And
I think they had to do something since they are aware that younger people are not using their platform as much as older people are, and so going forward in the future, younger people will probably still not be using. They have to have something else to do besides just have Facebook.
Yeah.
Oh, they stopped the Russia using Facebook, blocked the Russia.
Yes.
Hey, you said the supply chain disrupted their business. How does supply chain?
No,
they are using services.
Not there, but the supply chain disruptions affected the people that they're advertising for.
Right.
Yeah, not Facebook directly, but the people who advertise on Facebook.
Right.
Their products were affected.
Their products are stuck on a boat somewhere. They're not advertising.
Correct.
But things should pick up because it's getting ready to be December.
We'll see. Monkeypox, more COVID. I don't know.
Well, you know,
It's like,
just as an aside, I'm not particularly happy that Facebook was the company that gave information to the state about the women involved
hello?
Yeah, what
in
is
trying
that?
to get an abortion.
Oh, that's terrible.
So the state got information and we would prosecute women because Facebook gave them the information. Yeah, the women were talking about it over Facebook, and so Facebook
Mhm.
gave that information to state prosecutors, and they're now prosecuting the women. So, and you know, Facebook has not had a really good PR
Hmm.
about a lot of their political doings. They do
I
stuff
have
like
not
that.
heard
So,
that.
just saying.
Hmm.
I
Yeah,
also have.
I'm trying to think what state it is. I think it might be Indiana,
Mm,
or one of those states that recently passed a law that says you can't have an abortion no matter what, or you
Mhm.
can only have an abortion up to 2 weeks, or whatever it is. But there are a bunch of states that have passed very restrictive laws. And recently, it might even be Texas because they're real mean. They
Yeah, it's also like Kentucky, I think, is
Facebook
also.
turned over some
Hmm.
oh, we lost Isla. Hey,
Oh,
I'm looking.
messages from their
Oh,
platform to the state prosecutors so that they could arrest and prosecute the women.
Are they
wow.
required to by law though?
Yeah.
I mean, it seems like
If
Facebook
they,
itself is
here's the
pretty
thing with
liberal.
tech companies.
Yeah.
Initially, government agencies, including the feds, may ask them and they could
Mhm.
refuse. But recently, what has been happening is the feds and any state that asks, they give them the information. So if
Yeah.
people talk about various and sundry things on their platform, then you're likely to have that information turned over to government agencies.
Well, why would anyone talk about
They don't
anything
fight it,
then?
they don't refuse.
Why would you
Well,
talk
that's
on
the
Facebook?
problem. I think one of the things that's going to happen is that people will eventually stop talking about things on these social
Yeah.
networks because
Okay.
you'll end up being prosecuted. I
Mhm.
mean, honestly, look at the other half of it is some of the people who were involved in the January 6th mess ended up
Mhm.
broadcasting their stuff on social media. So
Yeah.
that's how a bunch of them ended up being prosecuted because they were busy, you know, live streaming on Facebook, or they made comments once they got home or whatever. So you have all of this information on social media about what you've been doing. People talk about all kinds of things on social media. You know,
Yeah.
some things are legal, some things that are not necessarily illegal, but maybe immoral or unethical, and they still talk about it anyway.
Hmm.
So as
We
long as
have.
people talk about that stuff, it's you know, it's depending on the laws of the particular state or the feds, they may turn that stuff over.
So we have on Facebook since June 2017. Guess what's our gain percentage of a gain? Take a guess.
It's probably pretty good.
7%.
What is
What?
it?
7%.
7%?
Yes.
Just because it's gone down so much?
Probably.
But it would have, wait, from 2017?
Yes, June 2017.
Well,
We
it's
own
lost
90.
about half its share price since about a
That's
year ago.
true. That's
Yeah.
true. That's true. That's true.
Yeah. And also too, we have to realize it is a large company. So, you know, I think
They're
the
not gonna,
target,
yeah. They're
it's
not
going
gonna
to
grow.
be,
They're not growing at 10 or 15% anymore. That's never.
yeah.
Disney, we have a Disney 13%.
But still, I
So,
mean, that's pretty good for a very large company.
yeah.
If it's 13%, 7% is not horrible for a very large company.
Yeah. What was it up until a year though? You know, it was probably double digit for sure.
I'm sure it was. I'm sure it was
Yeah.
double digits, but everything got squashed in 20.
Yeah.
Everything started going down in 20 and 21. So things.
Yes. So that's why I recommend if we believe in this company, this is a buying
Mhm.
opportunity,
Right.
right?
Yeah.
If we don't, we should just hold.
Right.
I don't think it's a good time to sell. I'm sure it's going to go up.
No. Mhm.
So
I
Yeah,
would
if we
would
give
be
the
my
market a chance to recover, I think the price
That's
will go up some, and then
yes. I
yeah,
agree.
it's
Yeah.
not.
Actually, didn't we trim
we did.
Facebook long ago when it went at a higher price, right?
Yes. Yes.
So we did a good job with trimming.
Yeah.
Yeah, I think the price will go up. So just wait around, see what happens.
I did have another question on Yahoo. There's this growth estimate. There's a sales and then there's a growth estimate of 7.53. I cannot find a definition of what it's not PE. because there's a separate line for that. If anyone knows what this is, let me know. 5-year growth estimate of 7.53. Don't know what that means.
Was that
Where?
on that page with all the percentages?
Yeah, it's on Yahoo's. Let's see. It's on Yahoo's. Let me, Yahoo. Okay, here we go.
I've always interpreted that as
On
earnings.
Yahoo?
Earning, yeah,
Finance?
me too. Me too.
I've
As
always-
what?
Earnings
Earning.
growth. Always
Yeah, that
interpreted-
page.
Here's earnings, right? Here's earnings
Yeah, so
next
it's all the way
year.
down at the bottom.
But then you go, it
So
goes to
that's
growth.
earnings,
Yeah, that's earnings.
but that's dollar amounts. That's dollar amounts.
Oh, it's a
So this is
percentage, though.
earnings. This is earnings percentages. The other one is dollar amount. Yeah, this is
Yeah.
earnings percentage
Percentage.
growth.
Oh, this
And
is
at the
doll-
top is earning is dollars.
Oh, okay. So I didn't.
That's
So they
dollars.
don't have to do the calculation. They just give it to you. Okay. So
No.
like
No.
Well,
Yeah,
current
they give it to you
year
at the bottom.
is current year is what?
this year.
Average
22.
10.4.
22. Right.
Current year
Because the high would
10.4.
be, yeah, because they give you the high and the low and the average.
If we
for
take
what they think
average,
it's going to
But that's only one.
10.5 to
Yeah, but
what
that's
is
only
that?
1 year out.
Right.
1 year out, but they're
That's
saying
next year.
5 years out is
That's right.
okay.
That's
It's
at the
down
bottom.
and it's
0.5.
77.53%
Yeah, for
Got
5
you,
years.
okay.
annually for 5
Okay.
years,
For 5
which
years.
is not
Okay.
bad for a company that size.
Yeah, it's not too bad.
Okay. Okay. I'll change this back when I'm done. Okay, cool.
Fabulous.
That
Fabulous.
was my recommendation. Any questions? Any more questions? Okay.
You haven't also quarterly number down. Are they just one quarter, or it has been trending down all the last just 3 quarters? Can I see the SSG very quick?
Yeah.
I think you, yeah. The last page, 3rd page.
Yeah, it doesn't.
Of the last 3 quarter. Yeah. Okay.
Definitely going down.
Just the last 3 quarter.
Last 3 quarters.
I guess we just wait and see.
Yeah. Are we good?
Yes. Thank you.
Okay, thank you.
Yeah.
All right. Now, do I have to do anything to, somebody else can take the screen, I guess, next person?
Let's see who's next person was what's on the agenda. There's another sell, I think, or buy. I forgot.
Let's see, what is it?
I can
You can
go,
just-
or if someone else wants to.
Oh,
wants to,
FAF, John, yes, that's you.
if someone
FAF.
is concerned about they're on the border between hold and sell, that would be a good person to talk as well, because we do need to divest ourselves of one stock at this point. If we're going to keep 1-to-1. So yeah. All right. FAF. We just covered part of it with Piero on the education topic. Thank you, Piero. This was Bernard's company, and Piero is the peer reviewer. I did this over the weekend, and here we go. So the last one was 6.0. I had to dig for that, but I found it. 6.0 was SSG. I picked 3. It's going to be evident why below. I kind of just went with the analysts' projections for sales, and this is just preferred procedure, which is obviously a lot less than 16. But I don't know. I just went with the preferred procedure. If you want to do something else, you guys can help me with that. But as you can see, most recent quarter year over year, a lot down from the prior year. That was because partially they said that they did a lot of. Wait, was that Google? That was Google. Never mind. I did 2 companies this month. I'm getting confused. So this is just down a lot for the prior year over year, and down some for these 2 earnings and pre-tax profit for trailing 4 quarters. It is cheap, as was evident from the value line thing, 0.77 relative PE, and also just 7.2 is just cheap in general. 1.5 to 1 upside downside. You'll see that in a second. 9.1 compound annual return. Now you can read this. That'll be evident when we look at the
Ah,
income statement in a second here. That's why their EPS and pre-tax profit is so low, or takes such a dive on the SSG. We'll go there real quick. See, it's been taking a dive the past 2
oh, okay.
quarters, but they messed up on some investment, I guess, because as you can
Yeah.
see here, let me get this thing out of the way here for myself, at least not for you guys. But okay, so the only main difference here with their revenue is this right here, this net investment loss. You know, because it was positive 86 and now it's negative 133, so that's a over $200 million swing in terms of what comes up on revenue. They did only lose 133, but I'm saying, you know, like difference between these two is that much. So everything else, if you want to go through this yourself, you can, but everything else is kind of similar, you know. But the net income due to that loss on the net investment loss is 109. Net income is 109 versus 302 last year over year. For 6 months, 207 versus 536, because it was a little bit more lost over here and a little bit more gained in the prior year. So, or a lot more gained in the prior year and a little more lost. So that's where this decrease in the earnings per share and net pre-tax profit is coming from. And they said it was due to, I'm just going to go to the company. Did I take it away? No, I did. Here. So they invested in this company. It's kind of like Zillow. I looked it over a little bit, and I don't know much about it, except that it's kind of like Zillow Offers. It's not as big as Zillow, obviously, but it's, you know, they buy your home real quick, kind of a wholesaler type deal, and then they'll sell it again to someone else, and they'll fix it up a little bit and do quick flips and stuff like that. And they're like a startup kind of real estate company, and they invested in this company. They're still in business, obviously, apparently, at least with this website, but they lost money on this company. So that's where the loss came. That's where just the majority of the loss came from. Let me just try and find it real quick here. Yeah, OfferPad Solutions. I think it's the same. Tech-enabled real estate. See, that's it. Yeah, right here. So they lost money there, and that led to their downturn in the EPS. But I think that's related to like the results. But I mean, I think the reason that the analysts have downgraded the company, or at least the revenue, is because of the market, you know. And like they do say that I did see in the conference call, for every 25 basis point increase in the federal funds rate, there's a $15 to $20 million increase in investment income, as long as you don't lose it on OfferPad. So Fed has been raising the rates by basis points by 75 basis points per month recently. So if you keep doing that, or even if they go down to 50 or 25, it'll still lead to some increase in investment income. But will that offset the decrease in sales of homes? Because, you know, you raise basis points by 75 basis points, then less people buy homes, so less title insurance to acquire. So, because that's what they do.
Well, a lot of
So
people
that's why,
apparently are canceling.
yeah, go ahead if you want. Yeah, but oh, you're being cut off again. You got something going
Previous
on with your mic?
contracts they've started because the price has gone up and they can't afford it anymore.
Yeah.
You know, they have to know.
Yeah, right. So revenue growth for all these companies, it's negative for this year, and then less negative but still negative for the next year. So that's why I did 3, because I figure the Great Financial Crisis started kind of in 2007 and then the bottom of the market was in 2009 for housing, and then it climbed back up. So I figure this is a 5-year projection. I gotta reiterate that I know everyone knows that, but like it's a 5-year projection. So I figure could be even better than this, but I don't know, obviously. But so this is my summary, and I pretty much said all that already. So yeah, I wasn't sure what to recommend. We do need to, as I said, keep saying, probably get rid of one company unless someone wants to cover 2 for the time being, but we don't want to. You probably want to try to find a new one to add, a fresh one to add next month. So I don't think we want to. I don't know. It's up to you guys, but that's pretty much all I got.
Do
Any
we want to
questions?
have companies that are just growth companies?
Yeah, I think we should focus on fundamentals. I think we can go, you know, to the outside of the basics once we have more people and more money.
This is
Also,
This is because of their quant rating. Their quant is obviously these rarely disagree, Wall Street and the quant rating, but their quant rating from Seeking Alpha tells us that you should they give a warning on it. So
High
it's
risk
pretty
of
much
performing
because
badly. Ooh.
yeah. I'll just leave this here. People that can read that for a second here, but
well,
so they don't. The quant rating does not like it. The Wall Street says it's okay, whatever that means. There's these probably an aggregation, I would imagine.
Insurance companies depend a lot on their investment income, don't they?
Yeah, I mean,
Yeah, that's right.
apparently they messed up on OfferPad, so I don't know the details on there and on what happened there, but just what's in the 10Q. But yeah, so anyone want to comment on this, Piero? Maybe.
Well, you know why it did badly? It wrote a number of policies that it was losing money on, and then it tried to sell those policies to a third-party insurer, and wanted to get out of the residential business. So they're still losing money on that deal, but that they're going back into the residential business. They're just going to charge higher rates.
Oh, that'll bring more people in. Oh boy.
Yeah. Well, now with the economy the way it is, like you say, people are going to start saving money. They're going to go out without the insurance.
Well, you can't go without title insurance. You shouldn't go without title insurance, because then what happens if something crops up in the history of that house that you just bought?
Yeah, then it's either you put food on the table or take medications or get title insurance.
I think if you get a loan, they won't let you.
Yeah,
I don't think if you're buying an older home, I don't think they're going to let you do anything without some title insurance.
banks require the title insurance.
Yeah.
Yeah.
So they can not have other kinds of insurance, but I don't think they can not have title insurance, not to make the initial purchase anyway.
Because it protects the bank too.
Okay.
A lot of Seeking Alpha guys like it. People like it, but I don't know.
Well,
This makes sense with me. Valuations, it's obviously cheap. I thought it would be an A- or whatever, but profitability, well, because of that mess up with OfferPad and what Piero mentioned, I guess that's down temporarily, but growth and momentum are not good.
So you said they were trying to get out of the mortgage business?
Well, they initially, when they wrote those bad policies, but they decided to shuffle off the bad ones to a third-party seller, and the ones that they were losing the most money on, they were just going to let it run out, not renew it, and then just get back into the private property residential insurance. They're going to keep it.
What did the value line say about this company?
I don't know. I'm sorry, but I always struggle with Piero saw that actually, so Piero could talk about that.
The last one was in June. I think that's the one Piero was showing us.
Oh, that was the one? Oh, okay.
Yeah.
So they probably have a new one due next month.
Also, guys, I think, Matt hasn't been attending and hasn't reported on Disney in a long time. So we might consider getting rid of 2 stocks, because it doesn't seem like Matt's attending anymore.
We will have a member to join. I don't want to. I know what you're saying. Do 101. Yeah, we can talk about it. I will say to get rid of the one that has the least potential.
Okay.
In my opinion. Yeah. Well, let me also follow up
anyone
with
else?
Matt.
Does anyone else have anything that's borderline? I know Google's borderline buy for me, but Alphabet. But
it is? Is it a good opportunity now?
It's a borderline buy. I mean, it's I thought it was good. I thought it was a buy, but then I took out 1 year's high PE, low PE, and the resulting relative PE was pretty much near 1, so it wasn't like a screaming buy. But it was they're doing pretty well. They had a rough year compared to last year when they crushed it. So that's why it looks bad this year. But anyway, that's Google. So that's in my opinion, that's a buy/hold, not a hold/sell. So anyone has anything.
Do you have SSG to show us for Google?
Yeah. So Google is also descending, but less sharply, and the revenue is still going up, of course. But what else I have here?
Can you cross out 2017?
Yeah.
Because it's the dip, outlier, something, whatever
Okay.
happened.
I'll show you what I was talking about before I get to the. Well, sorry, you can stay
I want to take a look at the management. Yeah. Oh, okay. Go ahead.
Okay. Yeah, go ahead. That's fine.
No. You can talk about your project. Why do you get 12?
Yeah. So
yeah.
I took this out because it's an outlier, and he does put it back in, and in that case, see, the PE is the current. I mean, it was current versus average. Current versus average was a big gap, so it was good.
Yes,
Then I took it
it's
out,
outlier.
and
Yep.
and it what's going on? There it is. Okay, 23.8 to 22.8. So it's not that. This is not refreshed though, but just one day. So
No, you cannot get it. That is the Friday price.
okay.
But the upside
Yeah,
downside is still 2.9 to 1. I mean,
Yeah,
that how
it's
much
close.
difference is that from 3?
Yeah.
Yeah. See, it's pretty close. And
Yeah.
here's what I.
29.4. Why do you give 29.4?
Oh yeah. I don't know. Good question.
Was that the
I
high
think
average?
there's a holdover. I think there's a holdover from the prior. Oh yeah, there's a holdover from the prior maybe. Yeah.
From the prior?
That's a
Yeah.
good question.
Okay. All right.
So maybe
Prior was
maybe
27.1. 2021 is 27.1.
let me see. But I'm just doing this just to see what it was. It showed up why I put that number, but yeah, see, that's what I did. I picked that.
Oh, I see what you're saying. Okay,
year
I
average.
see. Okay, yeah, you need to
Yeah.
cross out that. Yeah.
So it's probably like 24. If I'm just going to use the
Just do
average.
27. Just use last year 27. You do
Okay.
want to cross out the outlier.
That
We
makes it
agree.
worse.
Yeah.
Yeah.
Yeah, it will make. But it also depends on his projection. That's why I want to hear. Why do you give sales earnings that?
Yeah.
Can you talk about your projection on first page?
Let me see if I can, because I'm having trouble honestly remember. Maybe it's in my thing here.
Okay, Eli was
Yeah.
I added the value line to your folder if you want to look at the.
Thanks.
Because
Appreciate it.
you can also look at your triple play on that.
Okay.
Okay, sure. That's fine. One, my bad. What? Oh, man, I hate when it does that.
That company needs to be archived, I think.
Yeah, sure. I mean, I hate when I click something and it seems like it clicks the other thing. Yeah. Okay. Took a while, but there we go. All right. So PE is 19.7. That's kind of like.
Wait,
That's
what is
probably
what date is this?
Yeah, what day is it?
Hold to the bottom.
Going down.
Okay, sorry.
Oh, August.
August 5th. Okay, so not that long ago. Okay.
Yeah.
Let's start from price first. I'm practicing that. Price 108.
Below trend line.
The price is now what?
Oh, below trend line, yeah.
Below the trend line.
What is it now?
Yeah. Well, a lot of tech stocks have lost some price, so.
Yeah.
That's not, that's not a shock, actually.
Okay.
And it's not that much below the trend line.
Yeah. Okay.
It's not like
P.
So the PE.
Not like Facebook. 19.7.
19.7, and they're projecting 25.
They were projecting 25, yeah.
And the net profit is last year was 29, and they're projecting 29. Okay.
Yeah. Their projection is kind of trending.
Yeah.
Is up from the trend. The projection, except for last year. As I said, they crushed it last year. That's why their year over year is not looking so great sometimes.
Yeah, that's never going to be good. A lot of companies are going to suffer this year because they had great numbers last year and something.
Yeah.
So this company passed
the pandemic.
That's
right.
Passed the triple play. Okay.
It did.
Because the pandemic, that was the reason. FYI.
Well, it's a double play because their net profit is not really getting better.
Well, if you go back a couple of years, it's better than a couple of years ago. We're not going back a couple of years.
If it's staying where it pretty much is.
Well, last year.
In 20, it was 22. And 21, it was 29.
But I
And they're
think
projecting 29.
29 was an anomaly. I think that 2021 was
That's because people are coming out of the pandemic and trying to spend all
Yeah.
their money.
That's
Trying to buy.
Well,
People are
they
just buying.
nothing
Yeah.
else to do, so they're just buying online.
yeah. That's it.
Okay,
So
the growth rates,
Google is benefiting from that, from the ads. Okay.
Oh,
the
what's their
and-
revenue projection for farm value line? What's the revenue projection?
Yeah, on the left
$37.55. Yeah, I remember that somebody told me, I thought, what was the educator
Wow.
from BI was saying that don't look at that number. You need to do some sort of a calculation. So 2023, 2025, 20, so $37.55 per share. So something that I need to calculate that. So
Where?
it said that don't look at the annual rates.
Where?
I
Where?
know, but what is the calculation?
On the left.
Anybody
I
knows?
have the calculation. I document somewhere. I have to go look. Just a
They're
second.
on the left
Let
side.
me- He said,
Yeah.
The
what's
lower
his
left.
name? Yeah, don't look lower left.
Okay,
Look,
because
look
yeah,
at one. Yeah.
because what he was saying, that was Cy Lynch.
Oh, silence. Yes, thank you.
Yeah, what he was saying, that everybody interprets these numbers on the left side as for 5 years, like we do. But the projection that they're making here on the top right is out until 2027, right? So
Yeah.
they're projecting 2022, 2023 to
So
27.
4 years.
It's actually 4 years.
Yeah.
So it's going to be slightly less. Slightly.
Yes.
Wait, can you
Yeah.
show where you're talking about? Can you point?
Okay. Can you point? John,
Well,
do you know what
I
we're
think you were
talking about?
I think you were talking about over here first,
Right.
Yeah.
Right.
and then over
Okay.
here next. I'm not sure what
That's
the
right.
next one was over here.
Okay,
So what do you,
that's it.
okay, so what are we supposed to, where do we
Revenues,
get
come down, not revenues per share. Come down to revenues.
Okay.
Down.
All right.
There
Here.
you go. There you go. Right.
Yeah.
Operating margin. Okay.
But operating margin is different from revenues. Revenue,
Yeah.
No, he's pointing at revenues. He's really pointing at revenues.
Yeah.
so that's a number. Where's the percentage? Don't they do that number for you? So I've been doing it
Well,
wrong
no.
this whole time? Or what?
No, a little bit lower is net profit margin, right? 29.9.
But that's
I
still
Are we
not
looking at the
sales.
revenue margin or are we looking at the revenue?
That's different. That's different.
That's
We're looking-
different. Yeah, we're looking at revenue. So going
Because bottom left is revenue. So we're,
yes. Bottom
yeah.
left was saying is that
So the bottom left is a percentage, and the
percentage before
statistical array is a number. Is like money.
Yeah, you need to
Okay.
calculate because this projection 25 to 27, 3 years, 16.5%.
Right.
So the silence.
Yeah, but if you look on the left-hand side, it also says starting in 19 to 20, starting with the 19 to 21, an average of that,
No.
out to 25,
you have
27
a
again.
2023. You have a 2023 here.
Yeah.
Where?
2023 is 25, 65. So I need to get the formula. I think I probably put that in the education topic. Let me look. What was the
Okay.
calculation?
Because I always look at I use the, I put the years in there, but I say this is what value line is projecting.
Yeah.
I have
But that's
I have
wrong.
a comment. I have a comment on this left-hand percentage and the right-hand numbers.
Mhm.
Yeah.
You can start with left-hand numbers, but if you use left-hand numbers, percentages, right-hand estimates, you don't get it. But I put more weight onto the last column here to the right.
The right?
Okay.
2023.
2025 to 2027.
Wait, where is that?
Okay,
Where
you
is
put
that?
more. You put more
Right,
weight
the
on
rightmost.
on the very last.
on that last column. On that.
Yeah, very
right-hand
last column, I put
Right.
more weight because that's a little bit conservative, but the left-hand percentages are only for guidance. They don't match. Many
I
times
don't
they
know
don't match.
where the right
Yeah,
side
but
is.
if we're asked to do a percentage, how do we get from this
For example,
dollar figure to the percentage?
let's take earnings per share. Projected right-hand side is 10.1020, right?
Right.
Okay. If you use the left-hand percentage,
Mm-hmm.
can you go down a little bit? I cannot see the number. Okay. Left-hand
16.5.
earnings is 18.5. If you put 18.5, you may get
16.5.
more much. You can get you may get much more earnings per share than 1020. So I go
Okay.
by 1020.
Okay, but when you put that into the SSG, your projected growth rate, it calculates it out for 5 years, and it should be close to that 10-20.
Yeah, it
But how
should
do you
be.
do that? You have to put a percentage into the SSG.
But
Yeah,
that's
that
right. That's what
percentage.
you get on the left side. You get the percentage 16.5. That's your
Right, but
projection.
he's also saying that that should not be used. That should just be
Well,
a starting.
Well, that's right. Starting point, right? It's all information. So you just
It
put
just
it into SSG, see
you
what
can
it
start with 18.5, but you start adjusting to match the 1020 rather than sticking to this 18.5.
Yeah.
I found his PowerPoint. I have a harder copy. I can find that on the Better Investing, and then I can share with you maybe next time
Okay.
as an education topic. And then what he talked about, it's called the second opinion. Value line as a second opinion. So he's doing all the calculations, show us how to do it. I started using that formula, using his formula to look at the value line to recalculate my projection.
Do you find that it's more accurate, Jay? To
I
recap?
don't know. It's a bit more, maybe more conservative.
Oh, more conservative. Okay.
Hmm.
Whom are you referring to, Joanne?
And when you do it, is it closer to what is on the right-hand side, on the
No,
right-hand
it's
column?
not. It's lower.
It's lower than that.
Mhm.
Okay.
The left-hand numbers are over, they are not conservative. Right-hand numbers are conservative.
Yeah. Well, you can do it for the time being right now. You can just do, what did you give, John?
I gave a low number.
Okay, let's just go with
That's
12
all.
sales, right? What did you give for
Okay.
earnings?
Oh,
I just used it for
Using for
procedure,
procedure? Okay.
but
All
that's
right. Okay, that's okay.
seems pretty low compared. Well, I guess 99 is optimistic, is what people say, right?
Okay.
So,
Okay.
but it
That also went up. What did they do? What did they use money? They what? What did they do? Buying stuff?
what also went
What
up?
did they? That
Yeah.
that's
Oh,
on capital. The bottom.
oh, their debt. Oh. Mm, I don't know. Sorry.
Mm.
Don't know why their debt went up, but it was, of course, with a company like Google, it's so big. It's just,
We just need to understand
yeah,
reason why,
yeah.
like they acquire or something they did.
they may be
Well,
investing money in the Google Cloud
It could be
stuff
too.
that they're
Yeah, we
trying
don't know.
to, get that revved up
Yeah.
so they can compete with Microsoft and Amazon.
Mm-hmm.
yeah, but maybe we can move on for the
Google
time
is
being.
not competitor of Amazon though. Google is
Like I'm
not
saying, there may be
Amazon's
someone who
competitor.
has a company, maybe someone has a company they consider potentially selling. I don't know, because I don't think that you should sell Alphabet or Google, but yeah. So I mean, maybe someone has someone that can. We have about 15 minutes left, or 10 minutes, 12 minutes left before we go to
Yeah.
talking to the guests.
Okay.
So
Well,
Yeah.
I
Just.
do have a question. I was looking at FCX, the
Mm-hmm.
Freeport, the copper company thing.
Mm-hmm.
And it's a question I asked before about FAF and whether or not we were interested in only having companies that are going to grow strongly. Because FCX is not that kind of company.
What kind of company is it?
It's a very slow growing company. It's a company that deals in a commodity, mostly copper. Copper prices are set by an exchange in London, so they can't just charge anything they want. There's a limited amount of copper to be had, and you do have to spend a lot of money to get it out of the ground. And they, depending on, from year to year, they may be either number 2 or number 3 in the world in terms of how much copper they're able to mine. And again, the price of the commodity is set for them. It's not something they can just charge whatever. So they can't, they're, if the more they can bring out, then the more they can sell, and definitely there will be an increase in demand as time goes on for copper to use in storage for electric vehicles. Well, the manufacture of the vehicles and the manufacture of the storage capacity and so forth. So there will be definitely more use for copper, but again, they can't charge whatever they want. That price is set for them by the copper exchange in London, the commodities exchange in London.
Were
So
you
it's not
recommending
something.
it? Were you recommending it as like a hedge for inflation, sort of like we had for gold, or
Um,
what happens to it during?
well, recently the price for copper has really bottomed. In the last several months, the price for copper really bottomed, and part of that was because of the extended shutdown in China. So a lot of copper that is used in China to make all of the components that are then shipped all over to the rest of the world. So as China is shut down, there's not so much of a need for the copper. So when China opens up again, there's going to be another need for it, and the price may go up slightly, but it's not going to skyrocket. And even if it does skyrocket, it's not going to stay there because again, it is a commodity, and those prices are set outside of that company. So it's just something we have to consider and think about. It's not one of those, it's not going to be a grower like a Google or a Facebook or something like that. It's going to be one of those, it's almost sort of like a utility stock. It's there, and they pay a dividend and all that kind of stuff. So, it could be a very wonderful part of the portfolio, but it's not going to be that high growth company.
How fast does it grow?
Not very.
Okay.
We already do have Algonquin. That's a utility, right?
Yes, that's an Algonquin.
Yeah.
And although they're not exactly the same thing, utility prices are set wherever they are, their prices are set, so they can't charge what they want. And commodity prices are set. So Freeport McMoran, they mine copper, they mine gold, they mine silver, they mine some other stuff. They have a fully owned mine here in this country, in Arizona, I think in Colorado. They own some parts of mines in South America. They own almost 50% of one of the largest copper deposits in the world, which is on the island of Java in the Pacific. And they've had a lot of bad publicity about that particular mine. There were two mountains, and the first one that they mined, they completely leveled the mountain, and it had a disastrous ecological effect for that island. So the second mountain that they're mining now, they're tunneling in. Instead of just leveling the mountain, they're tunneling in. And so it's taking a little bit more money and a little more time to get the copper out now than it used to before. And the other thing that I came across is that there's a significant copper ore deposit in northern Minnesota that has been up for grabs for a few years, and different companies have been bidding on it. Several times companies have been given leases on the areas around the border between Minnesota and Canada. It's called Boundary Waters, and it's a protected area. It's part of the National Park Service, National Forest Service, and it's a protected area. So people have been fighting against letting mining happen there. And just recently, the leases that had been granted to various companies to start mining there, those leases were canceled. So that was going to be a significant thing for all for the copper mining companies that were involved in it, but now those leases have been canceled. So those are the kinds of things that face mining companies all over the world when they have to go to other countries and try to dig up their land. It's a problem for them.
Well, you're not selling the company very well, Isla.
No, well, my thing is that it's not a grower.
Yeah.
It's going to be a gamble.
Yeah, if we want to keep it because it hasn't, it's very essential. I mean, copper is an essential product.
Yeah.
It's so much of an essential that it's a commodity. It's not like a computer. You can make as many computers as you want, and you can charge whatever you want to charge for them. But copper is not like that. It's like water. It's like gas. It's like oil. You can only charge so much for it. And so we can keep it if that's what we're interested in. But if we're interested in a growth company, then maybe this one isn't the one.
Well, what's it called? Our portfolio should hold things that give us stability, and that one will give us stability.
It will do that.
Yeah.
Also, we have to keep in mind that we have to keep in mind that we need to trim stocks because of the membership.
Yeah. Let's
And
train one.
we have
Bernard's.
stock study coming up. So
Yes. So
No,
which one should we
Tyler.
train?
what did we
Tyler,
decide
you
about? What did
mentioned-
we decide about FAF?
well, we haven't.
Yeah.
Nobody's made a
haven't got to
motion.
the voting yet, Ben.
Okay.
We'll
Yeah.
get
Alright.
there.
FAF and FCX, you said?
Yes.
We
Uh-huh.
just bought that, right?
I
People-
know, but I'm so skeptical. I did not. Yeah.
You know, what's
I don't
funny,
want
I
it.
was thinking about it's like, you know, we've only been around for what, 6 years, 5, 6 years.
Mhm.
And then, you know, when we project 5. You know how many stocks we've sold? We
Yeah.
never hang on to them.
I know. So the only thing that's why I do not like
Because
this.
we-
I
yeah.
hold it for a long time as it makes sense. Disney
We
right
catch
now is the
things
only
when we
company.
catch things when they're growing. We catch things when they're growing, but a
Yeah.
lot of companies don't grow for that long a period of time.
Yeah.
So we hold it for 5 years. The
I-
only company is Disney.
Can you hear me?
Yes.
You know, Jane.
Yes.
Yes. I think we just purchased FCS and the copper price was bottoming when
It
we
was.
purchased it. And the demand was there. And we are not looking for to buy all the growth companies. In the portfolio, we need to have different types of companies. Okay. And I can't see that how can we divest a company when we just purchased last month.
Yeah.
And also,
Yeah, I wasn't trying to say that we should sell it, but I just think people should understand what kind of company it is.
Yes, yes. I think every time you want to suggest a sell, you need to do a
Yeah.
SSG, you need to comparison with other companies which are potentially a sold. Okay. Secondly, you just recommend to sell BMRN. How much it has increased over this month? So things like that. I mean, we all make judgment mistake, but which is okay. We just need to stick with our philosophy. If you propose to buy something and everybody go in and buy, you will not turn around and next month and say we should sell it.
Yeah.
Well, I wasn't saying that we should sell it. I was just saying that I was trying to explain that it is not a company that is going to be a big grower for us. So if that is a part of
Yeah,
the
we're
portfolio,
looking
then that's
to
good. That's not a problem to be a part of the
grow.
portfolio, but just understand what kind of company it is.
But we will not have every company to be big grower in our company, in our portfolio.
That's right.
But we strike for. We would like to.
Yeah, of course we strive for, but it's not
Yeah.
not going to happen.
Jane,
And if you want to recommend to sell, please do a SSG and please do a comparison.
okay, Jane, this is an unusual situation because Bernard passed, Matt is no longer participating. We, as a club, can only, most of the members can only manage one stock unless you want to take 2 stocks. I mean, that's the situation with the club. We're kind of challenged with having to trim. Even if we don't
So I
want
have
you,
no problem. If you compare FCS with other companies that should be disposed and you all decide FCS should be the one to dispose, I have no problem. But firstly, we need to see the SSG. Cannot just be based on somebody's representation. We need to see numbers.
that sounds reasonable.
Yes.
Yeah.
Sounds sound.
Okay, well, let's go. Wait, let's stop and go back. At no point did I say we should sell it. I'm simply trying to explain what kind of company it is and that it does not it doesn't match that growth perspective that we were supposed to be looking for.
Everything you say carry away because we all respect what you say. So when you say something like this and indicating that that's a sell, then you have to
No,
present
not
the
necessarily.
SSG.
It's just understand if you want a company in your portfolio that fits what this company does, which is it's a steady earner. Definitely, it pays a dividend. In that sense, it is good. It is just not it's not going to grow spectacularly. And for a
As I
lot of
mentioned
people,
to you,
that's
not
a
every
good
company in our
that's a good part of their
is
portfolio.
grower. not every company in our portfolio is a big grower. Is that correct?
We were hoping one is not. You know, if we follow as BI told us, if you have 5, 1 will be star, 3 will be project as will be doing as well as you projected it, you
Right.
know, and then 1 will be the loser.
And I think
Yeah.
the BI philosophy is to invest in growth stocks.
And that
Of
was my
course we
point,
would.
was that if we're looking for growth stocks, then this may not be the one. But it does not mean necessarily that we need to sell it. We just need to
But we
understand
just
what
have to
position it
really,
occupies in our portfolio.
of
Okay,
course.
it's 7:05. We can discuss this further tonight.
Okay.
Why don't we just move on to the guest questions and comments? I think Mina left, so
Okay.
why don't we just go on to that? I don't know how. I can see them, but I don't know how to. Oh, I guess I can unmute them. Okay.
I'll unmute. Anitra?
Okay, great.
Anitra, you're unmuted. Okay, but you're, oh, hi Anitra.
No, I just really enjoyed the webinar, and I thought the information was good. I do say that I didn't have any questions, but Facebook, to me, with the mega, I felt they seemed to be really desperate for people to get into it, because I like to watch the morning show. And I saw them, no, I said today, third hour, and they had one of the older gentlemen, and they were trying to make him buy into it. And they were, you know, of course, it's all to publicize and to get everybody, you know, to say this is the thing they want to do. And he was, it couldn't have been Willard Scott. I don't think he's around, but whoever it was. And he was trying to do it, and they had the face mask on him, and he, at the end, he said, no, I don't like it. I don't get it. I don't think I ever want to do it. And I think it kind of backfired, because I think they were trying to get senior citizens to say, this is the thing to do. He said, I only see half of my body. Where's my arm? You know, it just didn't work. And I notice on almost every show, they have somebody trying to show every week, trying to show how this is the thing. I love the explanation for the architect. Where you can show the buildings, you could do the, you know, the 3D, she can have a better explanation. They don't actually have to make a mold of the whole thing, of a whole city. You could put it on there. That made sense. But anyway, and I'm not a Facebook user too. I did sign up for it for things like to watch certain things on even Better Investing on there. But I don't go on there to communicate or to chit chat or anything like that. I don't think I've been on there in months. So I just loved your conversation about that. And I love the educational segment. I can't wait. I think you guys are on YouTube, but to go on there and to hear it again, because it was the dynamics of your communication and how you guys, you know, you just communicate so well, but not, you challenge each other, but you're in it, and you're I just love it. That's all. I'm finished.
Thank you. And we are on YouTube. This will be on YouTube in a couple, I don't know. Joanne would know better than me, but it'll be on there soon.
I'm gonna listen to about the triple play and the margins and the you know, and I just thought it was great information. It was moving fast for me, but that's okay. I can go back and listen to it. I just think you guys were communicating very well. I'm finished.
Thank
Thank
you.
you. If you want to join us, we have room.
I'm new. I don't know what I'm doing well enough to be a benefit to anyone.
We all started from knowing.
Started out.
We all started like you.
We're still learning.
was-
Most of us
we're
are still learning.
Yes.
Okay, well, thank you.
Brian, you're self-muted.
Oh, good evening. I agree with the previous talker that the presentation was very informative, and the discussion afterwards was also informative. I did have one thing about on Meta, when you were talking about the PEs, and at one point you just it seemed like you just changed the PEs because the upside downside ratio was 6.5, and so you changed the lower one lower, and in that. And I didn't hear any apparent discussion behind why that was done, other than to lower the upside downside ratio from 6.5 down. I think it was ended up at 3.4 or 3.5. However, earlier today, I was looking at Generac, and I did something similar, except that when I adjusted the PE for the high price, what I looked at was the current price, which is a trailing 12 months earnings divided into the current price, and that came out initially about 1.57. And so what I did was I changed the amount so that it was, I figured that I could handle a 1.2. And so then I redid the ratio and increased the 5-year average up so that the PE that I was going to use for the high price came out to be 120% for the relative value. So I had a reason to do it. I'm not sure that it's that much different than what you did, but I just thought that whatever my reasoning was, I had that rather than just change the price in order to change the upside downside ratio. The last one that I had was I think for title insurance there's actually 2 of them. One of them that the bank or the lender will have because they're protecting themselves, but it's always good for the homeowner to buy their own in title insurance in addition to what the bank does, because the bank could care less about you. They just want to cover their own money. So I think there's 2 kinds of title insurance that can be purchased. That's all I have. Thank you.
Yeah,
Thank you,
I think
Brian.
yeah, Brian, I think the only reason why we changed it on the fly, the PE, was because somebody said they thought it was too high. So that's the only reason why we put another number in there.
Yeah, and that's the same thing I did. I just had, I thought that I did one step a little bit cuter than you did, and that was I did it because I wanted the relative value to be just 20% higher, and so I lowered it to that. I'm not saying that that's right. That was just what I came up with.
Gotcha. Thank you.
Yeah.
Thanks, Brian. Jennifer, you're self-muted. Jennifer Peel, do you have any comments or questions? Okay, we'll go on to Ron. Hi, Ron, you're self-muted.
Hi, everybody. What a wonderful meeting. There's so much input and so much cross-references. I do have a couple of pointers that I want to point out. First of all, on that return on equity, I think there was a lot of definitions being thrown out there, but I was trying to keep it simple. And the way that you take a look at the return on equity, you don't always want to have the highest return on equity. The reason being is, let me give you an example of a house. If I buy a house for $100 and I put 10% down, that's my equity. If the house goes up by 10%, the house is now worth 110. So the $10 above my $100 divided by the $10 of equity, the down payment that I gave, is now a return of 100% of my equity. But I still have a 90% loan that's outstanding. Now, if the house goes instead from $100 to 110, it drops down to 90. Guess what? I'm wiped out because I just lost all my equity because I still have a lot of debt. And so if you put down 50% and your house is worth 100 and it only goes up by 10%, then your return on equity is 10 on the 50. It's only 20%. So people are saying my return on equity is only 20%, but you are in a more financial, stronger balance sheet because you put 50% down. You have a lot of equity in there. So you're not going to go bankrupt or you're not going to get wiped out right away. So the return on equity, when you look at it, technically speaking, in my standard, if the return on equity is at least 30%, which is the 30% debt ratio, you're doing extremely well because you still have 70% of equity in the company. So that's just one point I wanted to make about the return on equity. Now on the Google that you guys were looking at, you're saying that your net profit margin is 29.9%. So technically it is not growing, which is correct. But you have to be able to interpret that. That 29.9% is based on sales. And Google sales, if you pull up the value line, you can see that the sales went up. So it's a 29.9% on sales. And so that 29% makes a big difference because your sale is going up. Okay, so there is growth there, even though the value line is not showing the growth, but there's a lot of sales. And when you look at this Google right here, there's a couple more things that I would like to see. I like to see the earnings per share detailed estimates and the sales detailed estimates. I also like to click on the net income, and I would like to click on the free cash flow that you see right there on the legend. If you do that, then you have a better picture of the company. Okay, so you can see that maybe after the split or whatever happens, it went down. Now, when you make your projection, you click on the bottom two, the sales detailed estimates and the earnings per share detailed estimates, and that's how I look at my SSG. And so you can see right here, they're kind of going down right now, but Google has a lot of cash assets, and the reason it went down a little bit is because they just acquired two more companies. One is the security company that they bought for a couple of $2 billion, and another one is they bought another cloud company. And so they are all investing in their infrastructure to make it grow what in the future and get a bigger rate of return. Don't forget, Google has $150 billion worth of cash. They don't ever have to go to any bank and borrow any money. If the stock goes down lower, they can buy back their stock, which they've been doing also. And so this company is a very strong company. And then looking at Meta or Facebook, they're also building up in their infrastructure. Yes, they're paying a lot on their projects that they're doing right now, about $10 billion a year, but that's all going to pay off in the future. So if you are a long-term investor, then Meta, Facebook, is actually the cheapest stock on the market right now. And because we are long-term investors, you don't go out there and buy a company, you do a lot of research, and then you only buy one or two companies. And with those
You tell him,
companies, you
Ron.
hold them forever. So I know that Maguni, I
Yeah.
hope I pronounce her name right.
Sure.
She's got the right mental investment attitude, because let me give you an example of a farm. If I buy a farm and I get it, first of all, I won't buy a farm unless I get it at an intrinsic value. And then I keep it for 2-3 years. And then guess what? 1 year we have a heavy rainfall and the crops don't grow. So the farmers next door are all selling their farms. That's when I'm buying. Because what happens is that's when the stock is down, right? And you buy it and then you keep it. Now, after the crops keep harvesting within 5, 6, 7, 8, 9, 10 years, you got it all paid off. Your cost basis is back. And after that, it's pure profit. So always bear in mind the compounding. That's why you have to be so careful when you put a company in your portfolio. You just don't put it in there because the prices is in the buy range. Okay. And another thing that I think that you guys are doing extremely well is you're looking at the triple play. Is the price suppressed, where you can have a big increase. So you take a look at the value line, what's valuing right now, and you look at the left-hand side, what's the projection. You look at the PE expansion, and then you look at the margin expansion. But like I said, if the margin expansion stays the same, but the sales go up, that's based on the sale, because the SSG in the front, the sales is the most important line. Everything else trickles down from that. So I think you have investors in your club that are very smart, they're very intelligent, and they're very well educated. So keep it up.
Thank you.
Thank you, Ron.
Ron, you're going to give us the education topic next month.
Yes, that's correct.
The Amazon
Great.
split, I think.
You want me to do Amazon? I can do
No, I
Amazon.
don't know which one. I don't remember. I thought you said
It was
Amazon. Which one?
Amazon
Was
after the
Google?
split was what I was told. Amazon after the split is what I was told.
Yeah, and
Whatever you
basically
want to do.
what I will do, well, my name is spelled wrong. It's P-R-U-Y-N. But basically what I will do is I will give you that a 15 to 30-minute presentation. But it's also going to be mostly on, when I look at the stock, I look at its financials. And Jay has attended one of our focused meeting last month. Or was it? Yeah, it was the beginning of this month. So she knows what we concentrate on. And so I want to just relay that to your club. And that is just an eye opener so that your club can progress from the stage that you're already at now. Okay, so we'll take a look at Amazon after the split. How are they doing? You know, and are they really firing on all their 10 cylinders? It's a 10-cylinder car. You want to make sure that all cylinders, right, are really working. Now, another thing I want to say about Google, in my personal portfolio, that is my biggest holding. And I'm going to send Jay a report on Google and on Facebook after this meeting is over with, and then she can read it and she can kind of share it with you guys on the club.
Yes.
Anyway, that's my 5 minutes on the chair, and so I'm getting off my stool and give somebody else a choice.
Thanks,
Looking
Ron.
forward to next month for my presentation.
Yes.
Yeah.
I have a question for Ron. Can I ask him a question about Costco? Because I think he was on a call or somebody's call and mentioned something very positive about Costco, but I wasn't at the time ready, and I kind of wanted to know what he thinks about them now, if I can ask.
Well, Costco is a wonderful company. I have a big percentage of my portfolio in Costco because I gave a presentation on Costco on Stock Up. You can go to BetterInvesting, go to the Stock Up presentations, and you will see my presentation there from last year. But Costco right now is overpriced, right? So you always have to wait at the right entry point. And sometimes you have to wait a long time, and to just give you a little bit of so you can relate to it. Charlie Munger was reading the Financial Times, and he was watching this stock, and it took him 8 years before he finally bought that stock, and he put $80,000 in it. A couple of years later, he sold it for $800,000. That was about 10 years later, and then 10 years after that, he gave it to Li Lu, and Li Lu made $8 million out of it. So it took him 20 years to get it to the right price just to get into that stock. But in the next 10 years, it went from 80,000 to 8 million. So you can be patient, you know. You don't have to buy every stock every time that's out there. You want to make sure, and I showed you guys, I don't know if I did or not, to look at the intrinsic value. And you want to buy at least with a 35% rate of intrinsic value. And it's okay to sit on cash, you know, because you're also making money if you can get it at a lower price. But make sure you buy quality companies, quality growth companies. And right now, the two on my list that I keep adding on, and that's just me personally, is just Google and Meta. So thank you very much.